Welcome everybody to another edition of RealCast. We've got Nicol Dynes, Judi Seebus, James Wallace, and me, Richard Betts, and we'll be looking at some of the key themes of the week, and also particularly taking a look at the logistics sector today. James, maybe start with you, just in terms of some of the sort of key themes that you've been looking at for the week. What have you been seeing?
Well, I think we start with the macro environment. The IMF last week released their economic forecast for 2020, and it was fairly bleak. And it was caveated with extreme uncertainty as to the duration and intensity of the contraction that we're now in. Some of the headline numbers were for global economic output, it's minus 3% now for 2020, and that sort of, to put that into context, that dwarfs the losses that triggered the global financial crisis, and it would be the worst contraction since the Great Depression of the 30s. And it's characterized by decimated public finances and massive spikes in unemployment. And we've seen that actually in the US in particular, which released just a few days ago their latest job losses, which I think now takes the rolling 1 month job losses to around 22 million, which is fairly astonishing. There were some other headline numbers in there, which included a contraction in the Eurozone area of about 7.5% in 2020, with Italy, the worst affected country, at 9.1, followed by Spain at 8.0, and the UK at 6.5. So these are all astonishingly deep losses for economic activity. The issue around financing for the kind of the recovery of the European economies is sort of taking centre stage in the political realm in Europe, and there's still ongoing wranglings over whether we're going to see a joint debt issuance at the EU level at the so-called Corona bonds, and that's still something that they haven't quite managed to agree on.
It's interesting. I had a look in that IMF report as well, and was struck by the fact that we were going to be doing a session later on this year and comparing Australia and Poland at the CE summit, and because they were the two countries that had the longest period of unbroken growth. They'd managed to get through the GFC and also the dot-com bubble and those kinds of things. But Australia and Poland both essentially posting lower GDP numbers going into recession. We've also seen a lot of reports about, I saw one from Knight Frank, for example, based around when the hotels and leisure sector might be coming back again, which was really sort of Q4 of 2021. But there is a sense now, I think, of people talking about the new normal. I don't know if anybody else is seeing that kind of idea coming through.
Well, we're seeing the new normal in Holland. They're talking about the 1.5 metre economy. I believe in the UK it's the 2 metre economy. The government is encouraging employers' organisations to draw up plans for each of the different sectors for when things start going back to a semblance of normality, or when things start to recover a little bit again, that we can ease the lockdown restrictions. We're seeing some initiatives and some plans coming through, but it's going to be very difficult for a lot of businesses, because if you look, for example, at the restaurant sector, a big restaurant will not be able to have more than 10 or 20% of their normal number of customers, because they have to abide by this 1.5 metre distancing regulation. So that means that their turnover will be maybe even less than their cost to operate. So there are a lot of issues that still need to be resolved.
Just looking a little bit, we had a session on logistics this week. Interesting also to see the discussions there, talking about different countries coming back at different times. And that's also been another feature of some of the interviews that I've done, particularly also looking at, whether or not Germany, as mentioned there, is going to come back earlier, because the virus seemed to have less of an influence there. So it'd be interesting to see how some of these markets come back differently, I think.
Actually, also in Germany, at the real estate level, we finally got some data from Savills. And actually, it's a bit of a strange picture in there. It looks like business as usual. These numbers are kind of showing the German investment market in pre-COVID bull market at full tilt. They actually had, in Q1, the biggest quarterly investment total in their records. It was around 26.7 billion euros. that, according to Seebus, is the strongest opening quarter of all time. And well, it obviously now marks the end of a 10-year cycle. In March alone, it was just shy of 11 billion in volumes. And that proves the point that I think that we've heard a lot in the last few weeks, is that deals in March that were already at advanced stage did in fact complete. However, just a final point, if I may, is that what Seebus also said is that in the early stages of Q2, in the beginning of April and the very late March, there's hardly any sales processes that have been initiated. And so the writing's on the wall for a significant decline in activity. But there will be wide variation between markets in Europe and between sectors and between risk grades of real estate. And so obviously non-core and secondary and tertiary will be far greater affected than prime and super prime.
Still seeing some deals come through in the residential sector. We saw them this week. Heinz buying in Copenhagen, and Catella buying in Hamburg and Vienna, and a regional town in Spain. But those deals were in the pipeline for some time, and I think they also represent the sort of deal that we may be seeing a bit more of, because I think the residential sector is probably one of the most crisis resilient sectors in the real estate universe.
That definitely reflects something that I'd picked up in one of the discussions that I had with Primevest, where they were still doing deals in the residential side, definitely.
I mean, one thing I would like to sort of say on that, because residential itself is kind of delineated between types of resi. And so one area where it might be less of a slam dunk going forward is like student accommodation. So we're seeing a huge sort of shift in kind of moving to education online. There's a huge amount of the demand for student accommodation that comes from overseas as well as domestic students, and we don't know yet what the future demand will be. There's already quite a large pipeline, not just in the UK, but all across Europe, for all the new schemes, because they were supporting this drive for education, these so-called structural demand drivers that were making that sector super attractive to institutional investors. That might not stay the same. Some aspects of build to rent will be less affected, but the future demand for student accommodation is something that we're yet to find out.
I think mixed use is going to be a buzzword in almost all sectors. I mean, if you look at the retail sector, I think that's also a candidate to see more of these mixed uses. Not just the traditional retail stores, maybe a bit of logistics, residential. I think we were already seeing that trend, but I think it may accelerate due to the crisis.
And let's pick up a little bit about the logistics one, Nicol, because we had the logistics session this week. What were your key takeaways from there?
I think there was general consensus that there will be a substantial redirection of capital towards logistics later on in the year. And to some extent, it's already happening. Long-term investors are already looking for opportunities in that sector. We had Union Investment saying they doubled the space they had in logistics last year, and they intend to double it again this year if they can. And other investors like AXA already saying they're building up their shopping list of opportunities throughout Europe. And the reason is that it is a very resilient sector, and it is going to be the winner if there can be such a thing as a winner from this terrible crisis. But it's certainly proving it's very resilient. At the moment, obviously, the big driver is e-commerce because of the lockdown measures throughout Europe. There are more and more people are shopping online and relying on shopping on e-commerce. But the figures for Italy apparently is plus 80% growth in the last couple of months because of the lockdown. And obviously everyone is looking ahead at what might happen in the future. But it seems that whatever happens, that's what came out of the briefing. Whatever happens is going to be good for logistics. Whether people do what has happened in China, according to Seebus, the Seebus offices in China have reported an 80% return to the places where they have been opened again. So people obviously very keen to get back to normal and going back into shopping centres, going back into restaurants and so on. Whether that's sustainable, whether that will happen in Europe, obviously nobody knows. But even whether that happens or whether things carry on very much as they have done during the lockdown because people have got used to shopping online and staying more at home. Either way, logistics plays a big role in the picture, so it will be a positive sign. And one other point that I thought was very interesting is that the return of spec development in the sector, that despite the crisis, despite the fact that as everyone is sort of in a wait and see mode, it's a good time for spec development. That's what a lot of investors are saying, because lower costs of building and possibly lower costs of labor as well as availability of labor, which has been a problem, as we know. It's a great sign of confidence in the future and confidence in the market that people are going for spec development at the moment.
I think both Robert and Ingo were both talking about that spec development, and also what I thought was interesting was the trend from that it will probably act as an accelerator in some ways for online, but at the same time it may also act, given the stretch on global supply chains, that it may also act to bring more nearshoring in, which is likely to be positive for Europe especially, because it may mean that the German car manufacturers may choose to have supply chains that are slightly shorter or have more diversity within those supply chains.
The fundamentals of the logistics market were already very strong before the crisis hit. And our largest, their vacancy rate at the end of 2019 was just 3%, and I've seen a figure for Copenhagen, 2%. So there's a huge amount of demand, and that's being accelerated at this moment. There's a need for more supply, a very strong need for more supply. So that these fundamentals are very positive.
Yes, as we were saying, the e-commerce trend and the positive trend for logistics is something that's been accelerated hugely by the crisis, but obviously it hasn't been created by the crisis. All the elements were in place there and just been speeded up. And there were some figures from Savills that the vacancy rate in logistics in Europe has gone a dip below 5%. That's across Europe for the first time ever. So that's a definite trend. And obviously in some places like Copenhagen, it's 2%. I think Madrid has the highest at 9%, but most places are around 5% mark or less.
It's often been said that the UK is ahead of Europe in terms of its e-commerce kind of growth rates, and that parts of Europe to different degrees were sort of lagging. And so one of the things that we might see in the course of next few quarters is actually a sort of a coalescence around a sort of a certain level all across Europe. And so a lot of these European countries will catch up, and that will create huge demand for warehouses. And to the point that you made around nearshoring, it will be in countries, I'm sure, like Eastern Europe, where the rent is cheaper. And so those countries may well be particularly beneficiaries of the future demand going forward.
Thanks very much to everyone for sharing your views. We'll be back next week looking at Germany as well as our regular roundup of the week. Look forward to joining you then. Thank you.